Test, test. Yeah,
So, for example, if up to your any question.
somebody sent me an email about that, so I fixed it. Check it again, and tell me if I did it right. Were you able to find it? Okay, good, good. Okay, tonight we have module 10, which is the most technically dense module in the whole class. Our authors throw 3 topics at us. So we're gonna touch on the accounting for leases, we're gonna touch on the accounting for pension plans, and then we're gonna touch on deferred tax assets and deferred tax liability. And when I look back in history of my career in accounting, deferred tax assets and deferred tax liabilities have given me more trouble than any other single subject matter that we'll touch on. Fortunately, as far as we're concerned, we just need to know the terminology. I'm gonna give you a couple of simpler examples. We won't go as deep in this class as you do in some other accounting classes. But it is a complex subject, and you'll probably see me stumble through the mental accounting as I can. Tonight also marks a pivot. I guess the second exam is still open, so this is kind of one of those trash lectures where I'm filling your head with material that is not on the current exam. So if you are anything like me, you internalize the material and then immediately purge it as soon as you can. So I call these junk lectures because it's not on the exam that's currently open. After tonight, we will pivot and start talking about finance. So we spent first couple of weeks talking about competitive strategy, quarters, 5 forces, value chain, SWOT analysis, that type of thing. Where's the company that you're doing work on position itself relative to its peers, and how does it compete, and what are its competitive advantages? Those are all management type conversations, competitive strategy. And then we really spent weeks 3 through 10, so the meat of the course on accounting and accounting. And every single one of those modules, we try to train ourselves as an analyst to think about where is this accounting subject? Where does the various accounting treatments? Where does various accounting treatments mean that I can make apples to apples comparisons? And where do I need to adjust that accounting so that I'm making proper comparisons? Next week, we're going to talk about financial forecasting, and then we'll move into valuation methodologies. So multiple analysis, we'll spend a week talking about discounted cash flows, but we're very quickly moving towards that point in the course where we will have gone through all of the testable material. And then we'll pivot once more, focus on the research project, and you can almost see the light at the end of the tunnel. But we got some work to do tonight. These are some dense concepts, so I'll jump right into it after I take questions. Is there anything that we need to talk about? I had a question about the sample exam. There are now questions posted out there for the sample exam. I would be able to throw those are out there. Anything else? Okay. Then lease accounting it is. FASB simplified our life several years ago. Lease accounting used to be more complex. There used to be 2 distinct accounting methodologies for 2 distinct different kinds of leases. The terminology still stands. There's still 2 types of leases, but now we account for them almost the same. I'm going to point out one subtlety in the accounting, and I'm going to point out some differences in the nomenclature, the naming, but by and large, the accounting is the same. Those 2 different categories of leases are operating leases and finance leases. Let's take operating leases first. Function just like you think they were. You go down to your Toyota dealer and they ran a 4Runner. So you're going to put $3,000 down, and then every month you're going to pay $600-700 on that lease, and you're going to report it as a lease expense. Simple. Financing lease is the second kind of lease, and that's a lease that meets one of 5 or 6 different tests, whereby we look at the parameters of that deal, we look at the contractual language, but that means leases or contracts. And we make the determination that that's a de facto purchase, meaning we're on the hook for 90% of the value of that automobile. By the time we get to the end of that lease, we will have basically bought it. And FASB was looking at some of these leases and they were analyzing the way companies were doing the accounting. And if you're a CEO or CFO and you wanna make your balance sheet look better, you don't want your debt to equity ratios to be quite as high. Well, you just lease an automobile, and then you don't have to put the asset and the corresponding liability on your balance sheet. Well, FASB said, no, that's hogwash. We're not gonna let you do that. So now you actually have to put the lease, the automobile, on your balance sheet as an asset, and you have to put the corresponding liability on your balance sheet as a liability. So now operating leases and finance leases both work just like that. You're gonna see, if we go lease an automobile, with both types of leases, you're gonna see an asset and a liability show up on the balance. A little bit of terminology here. I struggle with all kinds of things for one reason or another. It took me forever to figure out lessor and lessee, which one's which. So the way that I remember is that lessor has an O in it, and O means owner. If you own the asset, then you're the lessor. If you're renting the asset, you become lessee, and I remember lessee just like, well, that's the other one. It can't be the owner, it's gotta be the other one. So if that helps you out, maybe you won't struggle with it like I did. Our authors point out that it's a private contract, and that's important. So just like we talked about with bond issuances, just like we talked about with preferred equity, just like we've talked about several other times in this class, anytime you get a private contract between two willing parties, the fine print inside of that contract can say anything you want to agree to. You can write that contract with hundreds of different terms, lease period, interest rates, collateral, so on and so forth. So if this is a big part of your business, whatever company that you're gonna work on, leases are a big part of that, probably need to get down into the contractual language. And I say that just because that would be beyond the scope of this class to request the actual lease agreement for, I don't know, your Southwest Airlines, some of your airplanes, but it can be very meaningful. So if you're out in the real world working as an analyst, then yes, these lease agreements are exactly the type of thing you would request from the IR department, or at the very least ask about the covenants and their contractual fine print that's associated with those leases. Other than that, they work just like you would expect if you were to rent a car. Okay, now let's talk about the terminology. So here's a disclosure from Microsoft. We can see that when Microsoft leases anything, well, we determine if an arrangement is a lease at inception. Operating leases are included in, so this is the terminology right here, the second line. Operating lease, right of use assets, right of use assets. It's an asset, it's gonna show up on the balance sheet as an asset, but it's gonna say right of use asset. That terminology is your clue that it's an operating lease. Finance leases, so right here, finance leases are included in property and equipment, other current liabilities and other long-term liabilities from consolidated balance sheet. So they're just, if it's a finance lease, it's not gonna, you're not gonna be able to recognize it because it's just lumped in with property, plant, and equipment as if they own it. You'll only be able to recognize it on the balance sheet if it's a right of use asset. That'll indicate that it's a operating lease. And here's a specific example of Microsoft's balance sheet where you can see the distinction. So property and equipment, net of accumulated depreciation, just like we see on every balance sheet we've looked at all semester. 74 billion. Operating lease right of use assets, 13 billion. So it looks like those are up significantly from the year before. Operating lease finances. And for most purposes, it doesn't matter. And then most of the ratios that we're gonna be computing and most of the analytical work that we're gonna be doing, we just added these two numbers together and said, well, okay, they have property, plant, and equipment of $87 billion. That would be just fine. Where you're gonna see a little bit of differentiation, the nuance, I guess, if you will, is on the income statement. I'm getting ahead of myself. This is the bottom half of the balance sheet where you see the current portion of the long-term debt associated with those leases. That's the same for operating and finance leases. Then you have the long-term debt, that would be finance lease. And then you have the operating lease liability. Just a very slight offset and deviation in the terminology on the balance sheet. Here's those 5 parameters that will determine whether or not it's a finance. If at the end of the term, the contractual agreement transfers the ownership, that's finance. If there's a bargain purchase option in the fine print, that's a finance lease. If the lease term comprises the vast majority of the useful life of the asset, that's a finance lease. If the present value of the lease payments is substantially equal to the value of that piece of property. And then there's some other language under specialized assets. Okay, as with everything else that we've talked about this semester, find this table in your 10K filing. You're gonna see the total lease payments due over the course of the next 5 years. This is important for your liquidity analysis. So when you get to looking at your current assets, current liabilities, what's due over the next 5 years, we had the same conversation when we're talking about bonds. I cascaded rating class to find that table, understand what payments are gonna be due over the course of the next 5 years, and then understand where that cash was gonna come from. That was the whole conversation that we had around evergreen debt. Companies are funding these liabilities by going back to the bank or the bond market to borrow more money. That's a red flag. This should be incorporated into that analysis. Now, if they're funding this with cash flow, if they need to fund what looks like $15 billion in lease payments, and they have annual cash flow of 100 billion, and this is not even a conversation. But not all companies are as cash rich as Microsoft. Okay, for an operating lease, we're going to record the present value of the lease payments is going to equal our asset on our balance sheet. So the present value of those lease payments, we know what the lease payments are, those are clearly outlined in the terms. So we can put all that into a spreadsheet, discount it back at our discount rate of 2.09%. That's going to be given, or we can calculate it. We can use an internal rate of return calculation because we know the present value. The present value is whatever that asset would cost if we just bought it outright. We know the lease payments because those are given to us in the term of the lease. And then the future value of those payments is just what it would be if we added them all up at $15 billion. So if you put all that into a spreadsheet, you can calculate the discount rate at 2.09%. And that looks much like an IRR calculation right there on page 13. This is where it starts to get a little nuanced. That discount rate is important. And that's where you're going to see a difference on the income statement between an operating lease and a finance lease. If it's an operating lease, we're just going to have a single expense line item that says rentals. If it's a finance lease, we have to account for it as if we owned it. So if we owned it, we'd be making payments that had an embedded interest expense. That we had to book that interest expense. Knowing that interest expense is 2.09%, it's important. Now we can take 2.09% times the value and we calculate that interest expense. So when we do that, that's on the next. Well, I thought we had an example of how to do that here. Our authors jump to a different example, which is fine. Here we're calculating the total expense over the lifetime of a lease. Second bullet point there. Assume a company executes a 5-year lease requiring annual payments of $22,000. Pays $5,000 of initial direct costs prior to commencing the lease. So the present value of the lease payments at 4%, just pick that random here, is $100,000, and the company recognizes a lease liability for that amount. So we're going to recognize a right of use asset for $105,000, which was the present value of the lease payments plus the upfront cost. And then the total lease cost under both operating and finance leases is going to be the $22,000 times 5 years plus the $5,000 upfront for $117,314. Now, if it's an operating lease, that expense is just $117,000 divided by 5 years. We don't have to impute an interest rate. For a finance lease, that's where it gets a little bit more challenging. Our lease expense includes the interest on the lease liability plus straight line amortization of the right of use asset. So if we had bought a piece of property, plant, and equipment, that automobile, or that airplane, or that oil field, we're going to amortize that. We're going to have sort of a depreciation associated with that asset. So we have to factor that in. It's a finance. So for year one, our lease expense equals $100,000 times 4% plus 105 divided by 5. Our lease expense is $25,000. We're gonna amortize that right of use asset, and then we're gonna have an interest expense associated with that. That's gonna be reported after operating income. So this is the most important bullet conceptually. At the end of every accounting topic that we touched on all semester long. The conceptual question is then, how does this affect our ratio? So the operating profit will be higher by the amount of interest expense recognized as non-operating. Okay, so if you, as the CFO, had your compensation linked to operating expense or operating expense margin, and you want that to be higher so you can get paid, and you have the ability to determine whether or not it's an operating lease or finance lease because you're negotiating with the lessor and drafting the contract. Which one of those are you going to pick? You want this to be higher. If you want operating profit higher, which one of those leases will do it for you? It's the one that leaves your interest expense below the operating profit line. If we keep that interest expense out of operating profit, it makes the operating profit go high. The financing lease is the one that has the interest expense. So our office is going to do math for us here, but we're going to drop a portion of that total payment down below operating profit. We're in the exact same position either way, it's just a matter of reporting. And here's your cheat sheet. Start of this page. in 2 weeks or 3 weeks, when I open the window to take this exam and you're scratching your head trying to remember the difference between an operating lease and financing lease. If you have this page starred, you're likely to be able to quickly reference it and get the answer that you need to get a test button. So this shows the differences between how the operating lease shows up on the balance sheet income statement of cash flows and how financing lease shows up on the balance sheet income statement of cash flows. Primary differences being, again, there that the financing will have amortization and interest expense associated with it, and then interest expense is obviously a financing cash flow, whereas, I guess the principal portion of the lease, is classified as a financing cash flow. So put a little star by that table and you should have no trouble with lease accounting for leases. Okay, let's move on to pensions. Okay, I've touched on pensions a couple times in this class. We're gonna go just a little bit deeper in module 10. And we start by talking about defined contribution plans. So 401k plans. I suspect most of you have probably worked for a company that offered a 401k plan. If not, we're talking about a very, very simple retirement plan concept. Every 2 weeks, when you get your paycheck, you have the opportunity to take a portion of that, usually 6 to 10%. Sometimes the company will match it and set that off in a 401k. Now, that 401k is simply a retirement account, usually directly kept by Fidelity or Schwab or Vanguard or one of the major record keeping houses, and they have a whole bunch of investments that you can select from to watch your retirement account run. The portion of the 401k that your employer matches is recorded for as a pension expense on a bi-weekly or monthly basis. This is about as simple as it gets. The accounting for this just shows up as wage expense, pension expense. That's it. What is very, very complicated is when we change that basic bargain from a defined contribution, meaning that the employee is responsible for funding their own retirement, and we put that responsibility on the employer. That's called the defined benefit plan. So in this instance, the employer, ConocoPhillips or Microsoft or Boeing, they promise their employee a future benefit. So rather than promising, I'm going to give you $100,000 when you retire, they promise, I'm going to fund your retirement for life at the age of 65. So when you retire at age 65, you're going to start getting a check for $3,000 a month, or $4,000, $5,000. Usually it's a formula. And usually that formula is somewhere in the neighborhood of, we're going to pay you 80% of the income that you made on average for the last 3 to 5 years you were working out of company. And now that gets very complicated. I think I've given you the example of my grandfather. He retired in 1985 with a defined benefit pension plan from ConocoPhillips. So in 1985, he started protecting bail, plan check. Passed away in 2002, those retirement plan benefits extended on to my grandmother who's still alive. So from 1985 to today, ConocoPhillips has been writing my family a check for a couple $1,000 a month. That's 40 years. We're talking about 40 years worth of liability payments that ConocoPhillips has been paid associated with that defined benefit. Okay, so now it's our job as the accountants / financial analysts to understand how all this is going to show up on the balance sheet, because we have a liability. That liability has to show up on the balance sheet. So let's talk about some terminology here. The first one is projected benefit obligation. The PBO is the present value of the estimated benefit payments to retirees. Now, the PBO will be in the final. You find the pension section in the 10K, the disclosures, you'll find what PBO is. Now, the balance sheet is only going to record the net obligation. When I say net obligation, I mean that, accountants should take the PBO, subtract out any investments that they have associated with that retirement plan, and then the net difference is the liability. Now, that PBO can be something of a nightmare to calculate, because we need to estimate the number of employees who will reach retirement age while employed at the company. So if we employ 10,000 people and we promised them at the age of 65, we're gonna start giving them a check. Well, we know that only a small fraction of those employees who are currently 30 years old are gonna make it to 65. What is that fraction? Oh, yeah, that's kind of a big influence on the PBO. Salary levels at the company. Well, we have 10,000 employees and we know that we're gonna owe them all at the age of 65. We also have to know, well, how much are they gonna make? So for somebody that's 30 today, we gotta know their salary today. We gotta know their salary for that job in 30 years, because there's gotta be some inflation associated with that. And then we have to assume that somebody who's working for us today that's 30 years old is probably gonna matriculate. They're gonna become more valuable to the company, they're gonna get promotions and salaries and growth. So what is that estimate of salary growth for those individuals employed at firm over the tenure of their firm? Not easy. Years of service at retirement, so oftentimes these defined benefit plans, they will pay you 80% of the income that you made during your final 3 to 5 years, but there's a multiplier. So maybe it's 85% if your total years of service are over 20 years, or 90% if your total years of service are over 30 years. It's very common. Years over which the payments will be made. So that's the whole concept of, well, how long is this person gonna live? Have we just promised 20, 30, 40 years of payments to this individual? All that goes into the projected benefit obligation. And where it gets really complicated is when the actuaries sit down to take a look at all of these estimates that go into this number, which can be in excess of a $10 billion liability. Periodically, you have to take an assessment about whether or not your original estimates are unfolding like you thought they were. But just like when we looked at warranty expense, just like when we looked at accounts receivable write-offs, just like when we looked at other ratios, at some point you evaluate the estimate. Everything can adjust. It's going on, you get perfect estimate, you don't have to make a judgment. But that doesn't ever happen. You're not going to get your estimates. Well, if you sit down and you calculate a projected benefit obligation based on years of service at 20, and you look at the retirees last year, and there's a trend that, well, it's not 20, it's 25. Well, that could massively increase your projected benefit obligation. You could add billions of dollars in liabilities to your PBO. Okay, this last bullet point is important. The PBO, this amount, is discounted at a rate called the settlement rate. I don't know why they don't call it the discount rate, they just call it the settlement rate. And to make it more confusing, that question. Find out what your settlement rate is. If any of the companies that you're looking at have a defined benefit pension plan, find out what that settlement rate is. This is the rate that we're discounting all of these future obligations. So here's a conceptual question for you. What would you expect the settlement rate to be? This is a basic time value of money question. If you want to accurately record the liability that you owe somebody in the future, what would you discount that back to time zero at today to accurately record that? Rate of inflation at least. So if you took the investment account associated with this, so theoretically, every 2 weeks or every month, you put some money into an investment account, will grow along with your PDO and hopefully match it. So that's a very conservative number, because you would think you could just put the money in a savings and match inflation. Okay, great. Now, what's gonna happen? Let's call inflation 2%. If you make your settlement rate 2%, you're gonna sleep well at night, because it's a pretty easy thing to do to put that money in a savings account, in a bank. It's probably FDIC insured. Okay, you don't ever have to worry about not being able to fund your pension liabilities. I like that. Is your projected benefit obligation going to be higher or lower? If your settlement rate is 2% as opposed to 3%, 4%, 5%. It's going to be higher. It's going to be a lot higher. Because your future value and your present value, they're not going to differ that much if your settlement rate is very, very low. So the temptation is to make this number, the higher you make this number, and this is just an estimate, you can make it whatever you want. You just pick it out of the air and print it in your 10K. The higher you make this number, the lower your projected benefit obligation is going to be. That creates a challenge. Because if you're trying to fund your pension plan, well, now this is kind of a hurdle rate. You have to go out and build an investment portfolio that will track this rate. That's why I want you to find out what this rate is. If it's any higher than, well, in today's environment, the 10-year is trading at 4%. So 4% should be kind of a full. Then if we add a little bit of credit risk onto that, we should be able to get 5% without perfect too much. And then if we mix in a little equities, we should be able to get to 6%. So I would expect these settlement rates to be in the range of 6 to 7. If you see an 8 or a 9 or a 10, let me know. If you see 10, that's a big red flag. And you should call that. Okay. Okay.
The liability associated with the plan is the reason why some companies will get them.
Yes, yeah. They're so complicated for all the reasons that we just went down through, and the temptation to mismanage them is so great, because pension plans are extremely long-lived asset class liability. I mean, I played it out over 40 years. And that was one example of my grandfather, and we got pensioners on both sides of that quick. So you're talking about 40, 50, 60-year liability asset. What's the lifespan of your typical chief executive or typical CFO? On average, I'd say 10 is a pretty long, but CPO. So the temptation for the CEOs or to mismanage your pension plan so that you can make the company look good during your opinion. And that happens so often. You had enough of these that were run into the ground and bankrupt. The federal government stepped in with an insurance plan, and they started charging companies to even offer. So now to even offer a pension plan, you got to pay the government insurance, and they have insurance that makes pensioners partly whole if their company or something. Not very good. It just became so expensive to run. You don't see them, but they are still out there, and they can have a huge and outsized effect on the financial statements. So we need to know how they're accounted for. Especially we need to know how they're accounted for, because there's been so much games and shenanigans in this area. Funded status. This will be your actual liability. On the balance sheet, you're going to see funded status, which is the projected benefit obligation less the pension plan assets. Pension plan assets are exactly what they sound like. That's the investment account meant to fund these assets. And if your funded status is 100%, then you're fully funded, and there's really not much to talk about here. That's what you want to see, is a funded status that is about as close to 100% as you can get. And in today's environment, most pension plans are looking pretty good. So this chart goes back to 2013, and you can see the funded status for S&P 500 firms. In 2013, average funded status was about 85%. And then by 2022, had risen to 95%. And the market's up nearly 40% since 2022. So I would expect funded status today to be even higher than 95%. When the markets go way up, funded status goes way up, everything looks good. When the market crashes, you're gonna see funded status go way down again. Which is one of the reasons why I mentioned last week change in defined benefit pension plan funded status. It is one of the few categories that allows us to push through to other companies. There's huge swings that are gains and losses, but they tend to offset themselves over time. Here's the table that you're looking for. This will come with its associated fine print at the back of your 10K. You're going to get the PBO disclosed. I forget who we're looking at here. Does it say FedEx? So FedEx has U.S. pension plans. FedEx has international pension plans, and then FedEx also has post-retirement healthcare plans. We won't touch on these, just other than to note that they exist, and you're likely to see them if you go to the back of the NK. Those can be every bit as big as your pension plans. So think about how expensive healthcare is. My little family of four pays $26,000 a year for healthcare. Okay, if that's been promised to you in retirement, this can be a huge liability. But it's also not required that companies put that on their balance sheet. It's only required that they disclose it in the notes. So that's something good to know, because that can be a huge liability and it doesn't show up on the face of the balance sheet. Okay, just like with lease payments, you're gonna find a schedule of payments to the pension plan. So this is FedEx. If we look at their US pension plans, looks like they have close to 10 billion that they're gonna owe that pension plan over the course of the next 5 years. So again, when you're doing a liquidity analysis, the same question applies. Where are they gonna get this money? And then cash flow. Are they gonna have to go back to the bond market? What's their plan for scheduling, not scheduling, but paying off these liabilities, paying off these leases, paying off these bonds, so on and so forth. Okay, let's talk about pension expense that shows up on the income statement. Every quarter, a company that offers a defined benefit pension plan will report pension expense. That pension expense is comprised of all those bullet points we looked at a few minutes ago. So we know that pension expense includes a service cost, and that service cost is basically the assumptions that we make about how long are our people going to be working. What's the percentage increase in their salary? How are they going to matriculate from a lower level salary person to an upper management salary person? All those assumptions are embedded in the growth of the PDO, and we have to expense them on the income statement every year. That expense is called a service cost. There's an interest cost associated with that PBO on a periodic basis because we have a settlement rate, i.e. we have a discount rate. There's a time value money component with that projected benefit obligation. So every quarter, we have to record an interest cost. And then we have the return on plan assets. So if we have $1 billion portfolio of assets and we get a nice little 6, 7, 8% return, that's going to offset the cost. And then we have any actuarial adjustment. So if we change the number of people we think are gonna retire, the service record, or the inflation, or the salary adjustments. Those are called actuarial adjustments, and those can have an outsized impact on the financials. The four of those together create pension expense. Service cost, interest cost, investment returns, actuarial adjustments. Our authors give us 4 examples there that included wage inflation, years of benefits, discount rate / settlement rate, and investment return. If any of those that we just talked about become too large, FASB gives us the ability to smooth those expenses. And we smooth them by putting any gains and losses in accumulated other comprehensive income. And then over time, we amortize that gain. And that's at the discretion of the individual company. So for example, well, I'll get to it here in just a minute. There's a handful of companies in the S&P 500 that say, no, we don't care if our investment account goes down by $1 billion next year. We're not going to put that in other companies. We're going to put it on the face of the income statement and take $1 billion loss. And that's okay. Strategy gives companies the ability to choose that account. It's a little messy. It takes away from the usability. But I guess the stance is we're just going to leave it up to the analyst to factor that out. Okay. Here's the example I was looking for. It was the third bullet point. Verizon, IBM, Honeywell, FedEx, UPS, AT&T, they all have done away with the amortization of large gains and losses and other comprehensive income. You can see FedEx, it was 2019, they ran a near $4 billion loss through their income statement directly. And if you know that's what's going on, then you just make the adjustment, figure out what their net income or loss would have been, irrespective of that. And they probably give it to you if you go read the earnings release. I would imagine that's something that their management team probably reconciles for you on their behalf. Slide number 42 is a nice little cheat sheet. If you star this one, you can come back to it on the exam. You know, if the discount rate goes up or down, what's your probable effect on the pension expense? What's the probable effect on the PBO? Same way with investment return, wage inflation. Those are good conceptual type multiple choice questions. We covered all that. Okay, yes. All right, moving on to deferred tax assets and deferred tax liabilities. My favorite. Okay. Deferred tax assets, deferred tax liabilities arise because we keep 2 sets of books. The IRS has a certain set of rules that we have to abide by when we give them our financial statements of the entity. Certain things are deductible, certain things are not. FASB has there's set of rules that we call generally accepted accounting principles that we have to abide by when we calculate our financial statements for public use at the end of the entity. Those 2 sets of books don't connect. The IRS will sometimes make rules, the whole bunch of rules embedded in the big beautiful bill that are going to take effect next year. That one of them is an accelerated depreciation that real estate owners get. They can immediately take an 80 to 90% depreciation on like furniture items and a whole bunch of stuff that was in that one. Well, that's not acceptable for GAAP. So those 2 sets of books are not going to match. And the way that we reconcile for that is by looking at either a deferred tax asset, which means that we've paid more in taxes than our GAAP statements show. If we pay more in taxes than our GAAP statements show, we have a deferred tax asset, which means that sometime in the future, we'll be able to pay less than our GAAP financials show. Deferred tax asset. Sometimes it's the other way around, and we'll have deferred tax liability, which means that today we paid less than what our GAAP financials show. And so at some point in the future, we're gonna have to pay more because there was a mismatch between the accounting methods. Those are always temporary differences. One is greater or less than today, and in the future, it reconciles itself. I'm hopeful that this becomes more clear as we look at a couple of examples. The simplest example is depreciation. And depreciation is one of the most common because the IRS is, they use depreciation as one of the most common incentives to get businesses to buy property, plant, and equipment. You want to spur the economy with lower depreciation and get business owners doing that. That's been new equipment, new real estate, new R&D. So very oftentimes you'll see accelerated depreciation methods used for the purposes of internal revenue tax. And very often you'll see straight line used for GAAP because straight line's a better indication of the economics driving property, plant, and equipment. When you have that difference, you're going to see something like this. Let's walk through this example. Assume a company purchased an asset with 5-year life. They use a straight line method when reporting to stockholders and accelerated depreciation when reporting to the IRS. During the first 2.5 years, the tax depreciation is higher than GAAP. So on the chart here, you can see that clearly. Straight line is brown or blood red. I don't know what that is, brown. And the accelerated depreciation is the pink line. So in year one, we're reporting depreciation of 200 to the IRS and reporting depreciation of 100 to GAAP. Which one of those is going to give us higher earnings? Higher earnings. Yeah, because if you have a lower expense, you're going to have higher earnings. So year one, you have higher earnings for GAAP. Year one, you have lower earnings for IRS. If you have lower earnings, you have lower taxes. Okay. So here's the account. Assume a company purchased a depreciable asset with 2-year life for $100. For GAAP, it uses straight line. For taxes, it uses an accelerated method. Assume income before depreciation and taxes is $240. So very, very simple example. Hopefully it helps to add some clarity. So we have income before depreciation, 200, 200. Depreciation, 50 for financial reporting. That's straight line. 75 for tax report. That's accelerated depreciation. Okay. Income before tax, simple math, 150. Income before tax, simple math, 125. Income tax at 40%, so 40% times 150 is 60. Expense. Same over here, 50. Only in this instance, this is actually the cash paid to the IRS. So we sent the IRS a check for $50, but we reported via GAAP that we had tax expense of 60. So our tax expense doesn't match the check that we sent to the IRS. There's a $10 difference. Our net income over here was 90. Our net income over here was 75. So we're going to plug that hole. We have a $10 difference between the cash that we actually paid and what we booked on our GAAP financials. So let's identify the cash. We sent $50 worth of cash out the door, so we have a $50 credit to our cash account. We have a $60 tax expense over here. We just calculated that. So that's the $10 difference that we're looking for. So if we debit tax expense 60, then we need to also credit a deferred tax liability for $10. Now we have a balance to our basic accounting equation, assets equal liabilities plus equities, and we have a deferred tax liability, which means at some point in the future, we're gonna pay more cash than our tax expense should. Okay. Let's look at that reconciling entry in the future. At the end of year 2. The additional income taxes paid in the company's deferred tax liability is not satisfied. So. Let me go back to this chart here. So as we move out, you can see what was a deferred tax liability is going to reverse itself when we start reporting higher depreciation for straight line versus accelerated. That basic entry is going to reverse itself, which is what we see in this second year. At the end of year 2, the additional income tax is paid. So same example, only we've now entered into year 2. We have income before depreciation, 200 in both instances. Depreciation is still 50 for our financial reporting purposes, but now it's only 25 for tax reporting. Do the basic math, we're still going to report a $60 tax expense for GAAP, but now we've sent $70 to the IRS. There's that $10 differential. It's coming back around to us. These are only ever timing differentials. If you have a deferred tax liability, it will reverse itself eventually. If you have a deferred tax asset, same story, it'll reverse itself eventually. That's exactly what we see here. Net income 90 and 105. Here's our account. Identify the cash. We're going to credit cash for 70. We sent that to the IRS. We have a tax expense of 60. And then where we had credited the deferred tax liability for 10, now we're going to debit the deferred tax liability for 10, and that will wipe that off the books. Now we don't have a deferred tax liability anymore. We just doesn't exist. So it's completely reversed. Okay, deferred tax assets. This is really the flip side of the coin. If we have a benefit today, then we have an expense tomorrow. If we have an expense today, we have a benefit tomorrow. That's a deferred tax asset. We have a benefit tomorrow, deferred tax asset. If we have an expense tomorrow, deferred tax liability. So deferred tax assets arise for different reasons, for different accounting treatment. The example that our authors give us are restructuring costs. Restructuring costs, they may not recall from module 3, I think, that they're booked from time to. We have to get board approval on restructuring costs. We announce them to the public. They include any severance, any relocation, any scuttling of a business unit, which is all wrapped up into restructuring costs. And we report it as if it happened now. But GAAP ones. But the IRS says, no, we're not going to let you take a deduction for restructuring costs that you haven't actually paid. If you haven't sent the cash out the door, if it's a non-cash expense, then you don't get the deduction. So that timing difference is exactly the opposite of what we just saw. And that means we're going to end up booking a deferred tax asset rather than a deferred tax liability. Okay, I thought we had an example, but maybe not. Another instance where you will find deferred tax assets are with net operating loss carry forwards. So if a company has a loss on its books, the IRS says, well, if you lost $1,000 in 2025, then on your 2026 tax filing, you can deduct that loss from any income. That's a future benefit. If you've lost money today, you have a future benefit against your taxes tomorrow. That results in a deferred tax asset that will book today. The net operating loss carry forwards are an example of a deferred tax asset. And this final bullet point is actually worth a mention. Those can carry significant value. So if a company's been struggling for years, 5, 6, 7 years, their net operating loss carry forwards can be quite substantial. And we've seen this over time in different businesses. That it can prompt merger and acquisition type behavior. Because if you have just a company that's struggling and they have a lot of net operating loss carry forwards, they don't have a good plan for utilizing those in the future, meaning when they path to profitability, they're worth. With a path to profitability, you'll get the future benefit. But if you don't have a path to profitability, then you can be very attractive takeover target for a company that is profitable. This company that is profitable can buy your business and immediately utilize those deferred tax assets. So you can see a lot of hidden value associated in those net operating loss carry forwards or deferred tax assets at times. I'll pause here just because it's seemingly intuitive. But those deferred tax assets, they equal the future estimated tax deductible, like we just identified, times the estimated tax rate when we get that future benefit. So if we know that basic transaction is not going to reverse itself for 4 or 5 years, well, now we have to have tax. But what do we think the tax rate is going to be for 4 or 5 years? If we know Trump passed the one big beautiful bill last year, and I'm going to change my tax rate next year, well, now all those deferred tax assets, they need to be recalculated based on next year's tax rate. So oftentimes you see legislation that's passed that changes the estimated tax rates in the future, and that can have a big swing in the value of those deferred tax assets and deferred tax liabilities. And it's never as simple as just looking it up in the code. So get that pesky little word estimate. And actually, I feel very fortunate right now that we really only had the one thing. We only went through the accounting for depreciation. And Offers gave us an example that was a 2-year period. In year 1, we had the tax differential, and in year 2, it reversed itself. In year 1, we booked the deferred tax liability, and in year 2, it reversed. That's about as deep as we need to go. Because we probably see from just a few slides that we've reviewed here that this can be very, very complicated. But if you can understand that one example with terminology and the understanding that this is an area that you could name it if you wanted to make a whole career out of this deferred tax assets and deferred tax liability. But we're not going that deep. To prove my point, I share with you Yum! Brands. So this is Kentucky Fried Chicken and Pizza Hut. This is their deferred tax note for Yum! Brands. These are net deferred tax assets summing to 1.1 billion and 1 billion in 2021 and 2022. And every line item above that shows a category of tax treatment that resulted in a timing differential that resulted in a deferred tax asset. So in every category, employee benefits, share-based compensation, lease-related liabilities, accrued liabilities, intangible assets, property, plant, equipment, in every single category, there's some nuance associated with the way the IRS wants you to report your financials that's different from GAAP that results in a deferred tax asset. Same way for gross deferred tax liability. every single one of those categories resulted in a timing differential that left a future expense worthy of a gross deferred tax liability. So for the purposes of this class, we need terminology, we need the basic understanding that these are timing differentials, we need to understand the example that we went through with straight line and accelerated depreciation. We need to understand that there's gonna be a difference between the cash we pay and the tax expense we report on our books, and then we need to understand these two numbers. So for Yum! Brands, we know that in 2022, they had a gross deferred tax asset of $749 million. That's a future economic benefit. That's a good thing. We got a deferred tax asset on their books. Now, that may make them attractive to a certain acquirer or not. Because with a company like Yum! Brands, see all those categories that they have up there? Every single one of those is probably unique to their geography. Because now you're not only dealing with the IRS, but Yum! Brands is a global corporation. So you have taxes associated with all of the international businesses that they run around the world, which are all domiciled and reported in their own strategic independent operating units with legal structures in Europe and China and Japan and Australia and so on and so forth. So, if anybody just has an interest in that, or that sparks your attention, you think you would like something like that? No, you can go very, very deep into deferred tax assets and liability. Oh, it's a deep, deep rabbit hole. It's a deep, deep rabbit hole. Yeah. Valuation allowance. When we talk about net operating loss carry forward. If you have $1 billion worth of net operating loss carry forward and you can't see a path to profitability, you're not ever going to be able to use those. There are future offsets against profitable earnings. If you don't see a path to future earnings, then they're worthless. And your auditors are going to come in and they're going to tell you don't have a path to future earnings that we can take conviction on. So you have to report something called a valuation allowance. And the valuation allowance is a pink flag at best, if not a red flag. So if you see any of the companies that you're working on report a valuation allowance after several years of unprofitable operations, that's a red flag. Bring that flag in. I don't think you're probably going to see that just based on the environment that we've been in. We've been in a full market economic expansion. Most of the companies that we're working on have, storied track records. But just keep that in mind for future use. It's a definite red flag. And that's it, gang. That's my lecture for tonight. Those concepts are dense. So just let that marinate. Check in with the homework. I'll go ahead and check sample exam number 3, make sure I have questions out there for you to look at as you revisit some of this material. And if you need to bounce some questions my way, feel free to do so, because I know that that's some technical stuff that we want to bring. Any questions before we adjourn? All right then, Zoom crew, thank you. I'll get this lecture all packaged up and posted to our YouTube site.